Earlier today, Jerome Powell, Fed chair, raised the Fed funds rate by 0.5%, causing investors to wonder what's going on, what's next, what does this mean for the general economy, what does this mean for risk assets broadly, the stock market, does this mean potentially a next leg down? How can I potentially benefit from this rising interest rate environment, despite the fact that you're looking at inflation cooling off? Towards the end of this video, I'm going to talk about 5 ways that you can benefit from this current setup, as well as what's going on, why this is happening in the first place, why Jerome Powell still feels like he needs to keep tightening. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. So earlier today, Jerome Powell, the Federal Open Market Committee at the Federal Reserve, voted to raise the overnight borrowing rate by 0.5%, taking the targeted range to 4.25% to 4.5%. Now, a lot of folks are saying, well, why is this even happening? I mean, the inflation, which is the reason why they're tightening, is coming down, right? It's moderating. And keep in mind, inflation's a lagging indicator. It was from 9% a few months ago. Now it's 7%. I mean, yeah, the target's way down here at 2%, but you know, we're clearly heading in the right direction. Doesn't that mean you've done enough? And so a lot of folks want to understand, well, what's going on? Well, let's talk about what they see as going on, because this is the projections that the Fed talks about. So they talk about, look, they actually are still saying, oh yeah, soft landing, everybody. We're going to be able to achieve real GDP growth of 0.5% next year, 1.6% in 2024. So saying, hey, despite whatever tightening and pressures we've caused, we're still going to be growing. They are saying, yeah, you are going to start seeing some slacking in employment, where unemployment ticks up about 1%. I'm personally skeptical of both of these things. I do not think a soft landing like this, where you're going to say, hey, we're going to be able to keep growing like this, is in the cards, partly because once you get the unemployment rate start ticking up, it's hard to say, oh, let's just raise unemployment by 1% and we're going to stop it there. Oftentimes these things swing, one direction or another, because you have a dynamic system in place with the economy. Whenever you have people starting to get laid off, well, then they start, pulling back. The savings rate moves higher. People say, oh, I don't trust the economy. So then everyone starts pulling back. So you start this feedback cycle. And so it's really, really hard to orchestrate, something that's super smooth, where you say, oh yeah, we're going to grow through this whole thing. Don't you worry about a thing. And so this is another key aspect that investors are going to need to think about. And this is why I think you see a leg lower in the economy and you see a leg lower in asset prices, is because they're saying, look, rates are still going up. At some point, it's going to be somewhere between 5 and 5.5%. Now, a lot of Wall Street analysts were expecting, hey, 2023 was the year where they do the big pivot, where they start lowering rates. And they're saying, oh, that's not happening until 2024. We are sticking to this, higher for longer, to make sure that we absolutely crush inflation. And so they are still not on board with the, oh yeah, we're pivoting in the months ahead. So there's a huge divergence between what is being priced in Wall Street right now and what Jerome Powell is saying. Wall Street right now is saying, hey, this is pivoting. He's going to start lowering rates. He's saying, no, folks, I'm not lowering rates until 2024, potentially. It depends on how bad things get, or, if we're able to truly, if the unemployment goes to 4.6 and it just stops miraculously, around there, versus going up to, let's say, 5% or 6%. And so that's, their projection of getting rates to 5%. This is very short-term rates to 5% would have a lot of, impact to broader assets. I think that is worth understanding. And to understand, what is the market saying? Because keep in mind, the bond market is even bigger than the stock market. And so when the bond market is sending you a signal, it's either going to tell you, hey, the economy's hot, or hey, the economy's cold, or we're worried about it. So when the bond market sends a very clear signal, like it's doing right now, the Fed funds rate currently 4.25% to 4.5%. The only period, this is the Treasury yield curve. So you can look at the different times, 1 month, 3 months, 6 months, out to 30 years. 4.25% to 4.5% is higher than every single period outside of 4 months to 1 year. So this means the market is effectively saying, yeah, the economy is going to start stalling out, and people will be very happy locking in these lower rates, because things will get so bad you will have to lower rates. That is what the market's saying for the entirety of the yield curve. This is effectively saying we are going to enter a recession very, very quickly. And by the way, Jerome Powell, he himself is expecting weakness. He himself is saying, yeah, we're expecting unemployment to go up by 1% next year. It was 3.5%, recently. Now it's 3.7. It's ticking up higher, unfortunately. But he's saying, yeah, part of this tightening is that you get to 4.6. I'm saying it probably gets a little bit higher than that. That's, typically with that sort of dynamic economy, these things, you get feedback loops. And so looking at this, the market is clearly saying, look, the Fed funds rate is significantly higher than what you can get with a two-year bond. That's saying within the next 2 years, the market is effectively saying that the Fed fund rates is going to go a lot lower. And for that reason, getting 4% over the next 2 years is quite reasonable. This is effectively the market saying, hey, you are going to be tightening. You're going to see a recession. And this is no doubt in my mind a restrictive policy. That's effectively what the market's saying. You are actively sending the economy into a weaker state because you want to continue to cool off inflation. So now folks might be wondering, well, why are they still trying to cool off inflation? How can I even benefit from this? What's going on in Jerome Powell's head? Well, first, keep in mind, this is not financial advice. And if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. Also recently launched 2 new investment courses for enterprising investors looking to learn more, how to do it yourself in terms of financial statement analysis and understanding stock valuation. Is something cheap or expensive? A lot of people were burned this market cycle buying things that were way too expensive. And they were like, oh, I just didn't understand valuation. So a whole course set on that. So what's going on here? So first of all, Jerome Powell is still tightening, despite the fact that you are seeing some things decline in prices. People are talking about auto prices. People are talking about home prices. People are looking and saying, oh my goodness, why is Jerome Powell still raising rates when it's so clear that inflation's coming down? What he's nervous about is he looks at the economy in a couple of different buckets. He's looking at housing. He's looking at rent. He's looking at goods. Those things generally heading in the right direction. That is not why he's raising rates. He's raising rates because there's, as I think he called out during today's call, there's a 4 million people gap, 4 million body gap between demand and supply in terms of the labor market. That is a big, big, big deal. For example, earlier this week, I was talking to a member of the Unrivaled Nation at unrivaledinvesting.com. He has owned Dairy Queens for several decades. He's an operator of Dairy Queens. And he talked about how this recent cycle, the last few years, has been the toughest part over the multi-decades that he's operated. Mostly because the labor market is just so freaking tough to fill. It's extremely tough. And oftentimes, keep in mind, he previously was not stepping in the store. Now he's stepping in the store to occasionally help run the shop. Even though look, he doesn't know what to do in the kitchen. So it's more moral support. So I look at this and, first of all, I think Dairy Queen, man, Warren Buffett made a good purchase buying Dairy Queen years ago. It used to be a public company in the 90s. But I'm thinking about this, and this is the key component that has Powell continue to tighten. Because he's looking at this and he's thinking, yeah, these goods might be declining right now. But if you're still seeing wages increasing by 6%, well, in a few months from now, they're going to be spending those wages on goods. And then you start seeing goods pick up again. And so he needs to make sure all the components of the basket are heading lower. And ideally, it gets to the point where the Fed funds rate is even, let's say, above whatever the inflation rate is. And then once you get that, and let's say inflation's at, 4.5 and the Fed funds rate at 5, then he's comfortable. And that's, you've seen some historical loosening happen once you get to that point. Okay, the funds rate's here, which is super restrictive, overnight borrowing rate. You're pulling capital out of the system effectively. And inflation's below, then you can start loosening because you've caused enough damage. But that's the reason why he's saying, hold your horses, because there's this huge gap that's caused for a variety of reasons. Partly COVID, a lot of people retired. A lot of people got out of the workforce. A lot of people got their stimmy checks and said, hey, what work's no fun. I don't want to do that. And so you have this huge gap between supply and demand in the labor market, causing the risk of wage spiraling higher. which then gets embedded. Then you have unions ask for, hey, we want a 10% raise annualized over the next 3 years. Then the cost of living increases for elderly. So that keeps going. So the feedback cycle keeps going. He needs to break the cycle now. So that's what he's looking to do. The second thing is, I think you do see a market reset. I think you see a market reset because, once again, the market's saying, hey, you're going to start lowering rates in 2023. And he said, 2024. 2024, once we actually start seeing real pain, that's when we're going to do it. When you see unemployment at 4.5%, closer to 5%, that's when you're going to start it. We're not there yet. So you need to start seeing real pain before you see loosening. And so that is a big divergence between what they're doing and what the market's expecting. And as the market resets, and keep in mind, this takes time, because this isn't just like one hedge fund manager like going, oh, okay, now I'm going to sell or something like this. These are major institutions recalibrating, saying, oh, I can now get this more attractive yield, with cash. So cash is going to slosh around, and you see that pressure on equities. I think you do see another leg lower. I also think you see a leg lower in the economy. So I think you should expect that. Personally, that's how I'm looking at things. So then the question is, okay, so how do I benefit from arguably this ugly environment where one of the most powerful people in the world, the Fed chair, is effectively trying to orchestrate higher unemployment, impacting millions of people, and trying to close the gap in the labor market, effectively, lowering demand enough so that way, the gap between demand and supply in terms of bodies goes down a bit. This is an ugly setup. So how do you benefit? How can you benefit from this setup? First of all, the obvious solution is cash. I call out in a link below for interactive brokers. Cash is currently paying 3.3%. Now with this rate hike, it's probably going to be closer to 3.5%, maybe more. So I look at this and saying, if the stock market's closer to 20 times earnings, 19 times earnings, and you can get, a couple percent, it's not like you're sitting and getting nothing while you wait for incredible bargains. So you can hold cash, collect a few percent. Link for interactive brokers is below. That's, where I personally keep my investment funds at interactive brokers. So I like collecting that. I like having that cash going for me, so that even if I'm not swinging at a crazy compelling bargain, I could say, hey, this is working for me. Next, point number 2, you can have a company doing buybacks. I love that in this environment. One of my top holdings, as a matter of fact, pretty much all my top holdings, they're doing buybacks. I would love if all my stock, any of my companies, if they have solid fundamentals, I wish the stock fell at 90%. I wish, make it 95%. As long as they keep buying back stock, chef's kiss. Would love to see it. So I'm rooting for it. My top holdings actively buying back stock. One of my top holdings. The second way to benefit is a company that benefits from higher interest rates. So some, companies that have large cash balances, Berkshire Hathaway is a company that has, that's had like 100 billion plus cash balance. This is going to benefit them. Every percent higher, that's another $1 billion for a $100 billion portfolio. This is great. It's higher earnings for shareholders. It's another way to benefit. One of my top positions is an insurance company directly benefiting this. This is a huge impact, huge benefit to their earnings power. Another way, and this is, everyone has to figure out their own journey, but they have to consider, you don't have to do it. I personally choose to do it. I probably won't do it again, but some people choose to do hedging, where they either, short the market, buy puts, that type of thing, shorting various different ETFs. Hedging is definitely some way to get exposure if you do believe there's another leg down in asset prices. And I think that the fifth and really the most important way to benefit from this is ultimately, this is unrivaled investing. This is a channel focused on trying to create multi-generational wealth by finding exceptional companies. And one should view this period of tumult as, chaos being a ladder for opportunity. I don't know who I'm paraphrasing there. I don't know if that's like Littlefinger from Westworld or something. But the point being is that this is a period of greater challenge for a lot of investors. It's going to be a greater challenge for the broader economy. You should use this to your advantage. Have some capital ready to pounce on credible bargains. Look for great companies. And I'm calling out the great companies that I think are special and the prices and the valuation range to my subscribers at unrivaledinvesting.com. But this is a period to build up your portfolio in the things that you think will compound at attractive rates for the next 5 to 10 years plus, and say, hey, can I get this at a compelling valuation? Right now, valuations broadly, in my opinion, are not compelling. When you have the major indices trading 19, 20 times, that is not super compelling. When they trade closer to 15 times or less, and you're able to find a company that you have high conviction can grow at, let's say 15% or more, that is the setup for something very promising, especially if there's a lot of free cash flow there. So I hope this video talking about Jerome Powell, the current setup, why I think you can expect a leg lower, and how you can benefit from this current environment. I hope this video has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button, and thanks so much for watching.